the stock market recently dropped 15.5%, a correction that triggered widespread panic among retail investors. This price adjustment marks a specific turning point. The speculative froth that dominated the last few years has finally been eliminated. To understand what comes next, we have to look past the headlines. We're going to run a top-down X-ray of the market, analyzing broad index valuations, comparing the safety of large caps against small caps, and drilling into the data for IT, banks, and oil. Our analysis is based on the April 2026 Nitra report from DSP. As always, this is an educational deep dive into market cycles, not personalized investment advice.
In the investment world, we use the price-to-earnings ratio, or PE, as a primary way to check a stock's value. Think of this as the sticker price for the entire market. This chart shows the sticker price for India's 50 largest companies. Recently, that number has dropped below 20, meaning the market is becoming more affordable. When we factor in upcoming earnings, the price drops even further to 18.9. As the reference line shows, this puts the market exactly at its fair long-term average. Warren Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Reaching this historical average suggests the market has moved out of expensive territory, making this a prudent time to consider increasing your investments. However, a sale at a large mall doesn't mean every single store is offering a bargain. Some sections are much more attractive than others. The real value right now is found in large caps, the 10 most established premium companies in the country. These are the giants that have weathered every storm for decades.
The price tags on these top 10 companies have dropped into the 17th percentile. We haven't seen these prices since the high anxiety periods of 2016 and the 2020 pandemic. Meanwhile, the smaller boutiques, the small and mid-cap stocks, remain quite expensive. As the chart shows, they are still trading at a 59% premium compared to their usual historical levels. Because the top 10 companies are priced at rare lows while smaller stocks remain expensive, investors looking for a margin of safety are prioritizing these stable, discounted leaders over the higher-priced alternatives. It is natural to feel hesitant when the news sounds grim. How can we trust the sale is real if it feels like the market is still falling? We look for contra-signals. These are specific moments where widespread panic actually indicates that the selling has finally reached its limit. For example, the market just finished 4 straight months of decline. This is incredibly rare. Since the 1990s, only 7 episodes out of over 100 have ever lasted this long. These rare, long drops are historically followed by significant recoveries. On average, the year following a 4-month decline has seen the market rise by over 40%. We are also seeing the VIX, which measures investor fear, cross into a high anxiety zone. Reaching these levels of worry often signals that the worst of the selling pressure is finally cooling off. History shows that the periods of highest fear and rarest downward streaks are often the most rewarding times to step in and buy. There is an added bonus for India right now. The rupee is currently trading at a notable discount compared to other global currencies. This makes Indian stocks look even more attractive to foreign investors, which could lead to a fresh wave of buying. The most effective way to manage the current market breadth is through preset, disciplined allocations, like SIPs, which remove the emotional difficulty of buying during a decline. Buying assets while they are cheap relative to their own history provides a buffer against the kind of unpredictable volatility we see in major global panics. Systematically buying high-quality companies when they return to fair prices avoids the trap of trying to time market bottoms based on fear. Large caps allows an investor to deploy capital where the margin of safety is mathematically at its highest. Within those large caps, the most efficient way to filter for quality is by looking at return on equity, or ROE. This shows us which companies are generating the most profit from shareholder capital. Banks show a significant disconnect, with HDFC and Kotak trading well below historical averages. Similarly, IT firms like TCS and Infosys trade below average multiples, supported by buybacks. FMCG and oil sectors also show high ROE relative to their discounted prices. Value in this market is concentrated in these large-cap IT, banking, and consumer firms. While the general sentiment remains weak, these specific high-quality names have returned to attractive entry points. Given these valuations, the time for a conservative stance on equities is ending. The data suggests it is time to begin raising equity. The data suggests it's time to look past the headlines and gradually increase your allocation to high-quality large-cap companies. Identifying these moments is a great first step, but managing a portfolio every day requires specialized tools and expertise. Folio AI provides exactly that. It is a wealth management platform designed for every Indian investor, combining intelligent algorithms with human experts to give you professional-grade portfolio management. You don't have to handle market shifts on your own. Download Folio AI today and let the professionals manage your investments while the market is still offering these fair prices.